Hey, so what's really going on with foreclosures? Well, mortgage delinquencies are surging. Loans that are more than 90 days past due have hit a 22-month high, and foreclosure starts, they're also rising. They've climbed to an 11-month peak. But beneath all these complex numbers, there's a story that's unfolding. And what I'm going to show you today could completely change everything you thought you knew about the housing market. Hey, welcome to my channel. If you're new here, my name is Jason Ferrier. I am the housing nerd, and I've been a realtor and investor in Central Ohio for the last 7 years. I'm excited you're joining me on this mortgage and foreclosure update. Let's get going and dive into this data. All right, so we're going to review the latest Black Knight mortgage report. This is their February report. It actually goes back to the December data that wraps up 2024, even though it's labeled 2025. And by the way, folks, as always, this article is in the link below. You can go to it, review it in much more detail than I'm doing today. I encourage you to do so because there's some wild information in there that I don't have time to share with you. I'm going to read you this first statement because this is really telling. While the share of homeowners past due on mortgage payments remains low by historical standards, and that's true, we are overall way under historical standards when it comes to mortgage delinquencies. They go on to say, we expect mortgage performance to become a growing topic of conversation in 2025, especially among FHA and VA mortgages. They're basically giving us a hint. Hey, there are potential mortgage problems brewing right now, and you need to be aware of them. And they highlight FHA and VA mortgages. More on that in a minute. All right, so here are their top line indicators. This kind of gives us an overall picture of the delinquencies and the foreclosures and even the refinance activity. And this all ties into foreclosures, folks. So delinquency rate down 2 basis points. You can see that here. Basically, month over month, if you look from November to December, down 2 basis points. And it says the number of borrowers a single payment past due decreased by 41,000 borrowers. That's good. But then look below that. Loans 90 days or more past due hit a 22-month high, but remain historically low. They're right. Historically speaking, 90-day plus delinquencies aren't insanely high, but they have hit a 22-month high. Tell me what you think. Why are there more 90-day plus delinquencies out there? Personally, I think it could be high home prices, high interest rates, high cost of living, high property taxes, high insurance. Everything's high, insane, right? So then look at the foreclosure starts in the next box, up 50% month over month. A foreclosure start is basically when they start the foreclosure process, because you have to be delinquent, usually 60, 90 days to start getting those foreclosure notices. And then if you ignore them, then actually the foreclosure will start. And that's what they're tracking there and saying it's up 50%. They also say December starts hit an 11-month high, but remain below pre-pandemic levels. So while December starts are up and up 50%, they are still lower than the pre-pandemic levels. But you're going to find out why that is in a second. It's not all roses and rainbows like you may think. They say the number of loans in active foreclosure is still 32% below pre-pandemic levels. Again, what I'm going to show you today and some reasons why we're not seeing a ton of foreclosures, even though delinquencies seem to keep rising, is troubling for a lot of people. So stay tuned for that. Then over here, I'm just going to highlight real quick prepayment activity. That's down 9.8%. Prepayment activity is paying off the loan early. Now, it's not because people are flush with cash all of a sudden. They're like, look at all my money, I'm just going to pay off my loan. No, most of it is refinance activity. That's what we're talking about. So if you look, it says prepayment activity remained up 47.2% from last December. So year over year, prepayment activity went up, means more people refinancing. Let me ask you a question. Did interest rates suddenly drop to the point that it made sense for everyone to refinance? No. But a lot of people are probably in the situation where they have to refinance because of other bills, other debts, and they got to pay those off. Or they're just getting antsy and itchy because they want to access all that equity they have in their home. The last report I read from CoreLogic says that the average homeowner has $299,000 in equity, the average homeowner. So that's a lot of money sitting there, and people are like scratching themselves, like some kind of addict. And they're like, man, I got to access that cash, go buy myself a new car, buy a pool, I don't know, put a man cave in, buy some other kind of worthless item that will just appreciate and not give them any type of wealth. But at the end of the day, a lot of people are doing that. You are seeing less prepayment activity versus last month, but it's still up 47% from last year. Crazy. Comment below, would you refinance your house if rates were actually higher? Because you got to figure a lot of these people are refinancing who had 3-4% interest rates. Okay, now we're going to go on to the mortgage performance review. This is a top line review of just mortgage performance. And this information, again, startling stuff. While the share of homeowners past due on mortgage payments trended mostly higher in the second half of 2024, performance remains strong by historical standards. We know that. We said that earlier. But look at this. FHA delinquencies, on the other hand. FHA is a government-backed program for borrowers. Many times they're first-time borrowers. They usually have the loosest standards when it comes to borrowing, not subprime necessarily, but they require less down payment. A lot of times they have down payment assistance programs with them, and they actually allow a higher debt-to-income ratio and a lower credit score to qualify. So it's not conventional, it's FHA. And it says FHA delinquencies, on the other hand, have increased sharply, rising 74 basis points in 2024 and are now 2.5 percentage points above where they were just prior to the global pandemic. So it's not getting better, it's getting worse. VA delinquencies have also been on the rise, up 80 basis points in 2024 and 83 basis points from the beginning of 2020. So even VA mortgages are becoming a problem too, with FHA and VA loan delinquencies likely to serve as canaries in the coal mine, funny term, for mortgage performance in this cycle. We expect this to become a growing topic of conversation in 2025. Be alert. FHA, VA, the most, I guess, the easiest loans to get out there for home buyers, those are increasing at somewhat an alarming rate. And you're going to see that in a minute. So look at this. So this chart shows you mortgage delinquencies by severity. And I want you to pay attention to the 90 days or more delinquent. Because to me, like if you're 90 days delinquent on your mortgage, like you basically have decided, I can't pay this thing. I need help, or I need to sell it, or I need to get foreclosed on something. If you're 30 days late and you're like, shoot, I missed a payment. Sometimes that's a clerical error, whatever, but 90 days, and that's severely late. So like you could see back in the like GFC time, 2009, we had about 3 million, just under 3 million homes or borrowers, I guess, 90 days or more delinquent. Then it dropped and dropped and dropped. No kidding, right? As we came out of the GFC. And then it spiked big time in 2020 during the pandemic. Then it started to drop because they put a bunch of programs in place to kind of stop foreclosures and let people be delinquent and stay in their house. And those programs are still going on. We're going to go through that in a minute. But those programs helped stave off these delinquencies. They came down, they kept dropping, but now look at them. Now they're rising, and now they're higher than back here before the pandemic. So things are definitely getting worse. And you can also see it when you look at total delinquencies. Look at the black line. It spiked up to nearly 6 million borrowers were delinquent on their mortgages back in 2009. That dropped just like the 90-day delinquent line, went up during COVID, down, 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 sideways, and then up. So it's definitely trending up as of late. Hey, sorry to interrupt the video, but I wanted to remind you to subscribe to The Housing Nerd, like the video, share the video, comment below. I want to know what's happening in your local housing market, in your neck of the woods. Are you seeing a lot of houses on the market? Are you seeing a lot of foreclosures? Comment below and let us know. Back to the video. So this is the delinquency rate of first lien mortgages by product. So this tells you, and it kind of compares FHA to VA to normal conventional to portfolio loans. So look at this, FHA loans. You can see the black line here, right? I mean, look at the delinquency rate back in 2000. It was 12%. Then it spiked in 2009, I don't know, 14% approximately. And then it started to go down. And if you look, I just go back a second, look historically, like FHA loans were really they always carried a 12, 14% delinquency, it seemed like, up and down with seasonality, but it was definitely going up. Then it went down significantly after the GFC. Then it spiked all the way to nearly 16% during COVID. Then it crashed down sideways, but kind of started to trend up right after COVID. And now it's trending up significantly. So we're not back to GFC levels with the FHA delinquencies, but we're getting there. There's no doubt. Now look at the VA mortgage. That's the green line. Look at that. Same kind of story, right? Went sideways, then down until COVID, up dramatically, then down after COVID. but now again, just like FHA, going up and trending higher. Okay, so now this chart's pretty interesting because this shows us the non-current rate of first lien mortgages at the end of the year. So it shows the blue is delinquency, the black is foreclosure rate. And I like this because it kind of overlays both metrics, right? Again, got to be late on your mortgage to get a foreclosure. Look at the foreclosure rate back in 2008, 2009, 2010, 2011. I mean, it was obviously a lot more. There were a lot more foreclosures. Now, a lot less foreclosures, but you still have delinquencies. This map shows us what states have the worst mortgage performance, where people are behind the most on their mortgages. And you can see, like, the best is Seattle. Look at that, 1.7, Oregon, 2.0%, California, 1.1, 0.8%. That's probably San Francisco. Look at Los Angeles, 1.9. Look at San Diego, 1.6. So a lot of coastal areas on the West Coast are doing really well. Look at the East Coast, kind of the same thing. There are a couple spots that are higher than the West. Like what's this? This is probably Philly, 5.2. But you can see that's probably Washington, D.C., 3.2, New York, 2.3. Go down to the South, though, and you've got problems, right? Florida's picking up 5.1% for Orlando, 6.4% Fort Lauderdale, 4.5% delinquency in Miami. The worst, Louisiana, look at that, 8.2%. That's really bad. Texas is about like Florida, 5.8, 5.7. There is a bright spot there, 2.5%. That was probably Austin, or it could be Dallas. I don't know my geography that well in Texas, I guess. But you can see the higher numbers are down south. The lower numbers are out east and west, basically. But, you know, every market is different. I think it's Denver, 2.1%, right? So kind of gives you an idea of where the most pain is in the U.S. All right, now pay attention to this one, folks. Despite the gradual rise in mortgage delinquencies, foreclosure activity remains muted by the increased prevalence of forbearance and other loss mitigation efforts, along with the strong equity footing of mortgage holders in today's market. So there are really two big reasons why you're not seeing foreclosures as much as you probably should. We have a ton of equity in the system. That's one. So if you have equity, you don't need to get foreclosed on. You just have to sell. Like if I can't afford my payment and I've got 100 grand in equity, well, unless my house is destroyed, I can just sell my house, cash in some of the equity, and pay off my loan and not have the foreclosure hanging over my head and not have the delinquency over my head. But the problem is you have to actually sell to do that. Not everybody's in a position to sell. Why is that? Because going to the next place is really expensive, meaning what are you going to do? Rent a place for double what you're paying on your mortgage? If you can't pay your mortgage right now, what makes you think you could pay a higher payment with an apartment? Not only that, what are you going to do? Buy another house? Well, if you're facing mortgage delinquency, you're not going to be able to qualify for the next house. Probably going to have to move in with relatives or something. Makes it very difficult. So the first reason we're not seeing foreclosures, equity. What's the second reason? Well, the second reason is this, and Black Knight conveniently left out this chart I'm about to show you now. I had to go back to the previous report that I shared on another video with you guys, and this is like shocking. Foreclosure activity remains muted due in part to 70% of serious delinquencies still being protected from foreclosure by loss mitigation. Only 145,000 loans are at near-term risk of foreclosure, on par with 4-year averages. This shows you what the loss mitigation and foreclosure protections look like. So the black part here is no protection at all, meaning if you look at these borrowers in this black section, they have no protection. They're just delinquent. It is what it is. And this whole chart, by the way, is 90-day delinquent mortgages. That's what this represents. So then look at the light blue section, or I guess it's light blue, in forbearance, meaning they don't have to make a payment. So right now, about 60% of all delinquent mortgages are just in forbearance, meaning don't have to make a payment. We're going to tack it on at the end. What they do a lot of times is they take the payments you're missing, they put those on the back of the mortgage in another loan that's has 0% interest. This happens a lot in the mortgage business right now. And so you have that extra principal payment because you're not making payments. So it's getting tacked on to the end of the mortgage. But right now you're not having to make those payments. I have actually helped homeowners sell their property who haven't made a payment in 2 years, and they've been accruing all this deferred interest and deferred payments at the backside of the mortgage. But they had so much equity, it didn't matter. They sold the house and still walked away with cash. So they didn't make a house payment for 2 years, sold the house, got a check for 30 grand, paid off their mortgage, and walked away. This is going on all the time, folks. You got to pay attention to this, because look at the loss mitigation. That's the gray section, that there's probably been a workout. Like, hey, we modified your loan. We lowered the interest rate. We forgave some principal. Yeah, that happens. We adjusted the payment so you could afford it. Hence why foreclosures are so low. They're just kicking that can down the road and going, we'll just put you in forbearance, put you in loss mitigation, let you just stay in the house. Why is that? They don't want these houses. Banks don't want these foreclosures. They don't want to deal with these foreclosures. Everybody's running on skeleton crews. So they're like, well, who are we going to hire? We're going to hire all these people, to come in and deal with all these foreclosures. We don't want to do that. Banks want to lend money. They don't want to own houses. So they'd much rather keep you in your house than have to foreclose on the property. But comment below. I want to know what you think about these foreclosures, about these forbearances and loss mitigation. Do you think it's fair that they're putting people in loss mitigation and forbearances? All right, so the link for this article is also in the description below. But let me now go back to the latest report, that February report, and let's hone in on foreclosure starts. So again, look at the foreclosure starts. They were like, just average. You had about 750,000 foreclosure starts per year, almost 1 million before the GFC. Then it went up to an insane number, over 3 million foreclosure starts. These aren't completions. These are starts. But nonetheless, you had a lot of people having a lot of problems paying their mortgages, high delinquencies, a lot of foreclosures. But then it started to tail off because we got out of the GFC. People, reset their lifestyle, reset their expectations, and then all the way down to an insane low in 2021 because they actually had foreclosure moratoriums. They couldn't foreclose. Even if you were like, I'm not making a payment at all, they still couldn't foreclose during those years. Then they lifted those moratoriums for the most part, although there still is a VA moratorium on foreclosures right now. That's the other part I forgot to mention. You may not know that, but that is true. And then the foreclosures went up. But look, they're still muted overall, even though we are up a lot month over month. We're up 50% month over month in foreclosure starts. It's still muted, way muted compared to historical averages. And they're keeping it muted, folks, because they don't want foreclosures. Banks don't want them. The government doesn't want them. Now look at the foreclosure sales. These are how many are actually completed. So a lot of people thought during the GFC, we had like 4 or 5 million foreclosures in a year. Not true. Actually peaked at 1.4 million, looks like in 2010, foreclosure sales. That's a lot. Then it really dropped off a cliff in 2020 and 2021, less than, 100,000, maybe 50,000 foreclosure sales overall. Not much at all. Then it's been rising, but you can see it actually dropped from 2023 to 2024. It went down. So how can mortgage delinquencies be rising like that, but foreclosures be dropping? You know the reason: forbearances, loss mitigation, government intervention, interference, whatever you want to call it. What do you think the current administration is going to do with this brewing problem as we pile on more and more mortgage delinquencies and less foreclosures and keep kicking that can down the road? Do you think that Trump's going to pull the plug and say, you know what? No more forbearances, no more loss mitigation. I don't care if you voted for me or not. You're going down. You're getting foreclosed on. Or do you think he's going to say, you know what? Let's just keep these things going, extend and pretend. Let the next guy or gal deal with it. Comment below. I want to know. Now I want to go and show you what I do to look for foreclosures, at least one way. And that's by looking at my local county. Where I live in Ohio, the county sheriff controls the foreclosures. And so this page you're looking at is my county, the sheriff sale, they call it, the Licking County Sheriff sale page. And you can come in here and look at different properties. And these are all the results from the past few weeks on the foreclosure auctions. And so you see the information, the address, the city, obviously the appraised amount, and oftentimes the appraised amount. So this one would start at 2/3 of $225,000 at the opening bid. And then you can click on the parcel number, and actually it takes you to the auditor site where I can look at the actual data on the property. It takes a second to come in, but here it is right here. So it gives me all the information on the property. This is a way you can find foreclosures. Maybe you have a similar setup in your county. Not all counties are alike. Now, one thing I will point out is that a lot of these on this page anyway are all mortgages. But if I go back to 2024, look at this tax sale, right? Look at all these tax sales. So these aren't from mortgages not being paid. These are from taxes not being paid, property taxes. And I'm seeing more and more of this. So That's one kind of like outlier, is that if they kick the can down the road with mortgages, property taxes, if you don't owe anything on your home, you still owe property taxes. If you don't pay those, they will definitely foreclose, and there's no moratorium in place for that, folks. And property taxes can be wicked if you don't pay them. The fees are insane. I forgot to pay a property tax on one of my investment properties last year. I missed it, just clerical error, overlooked it. It was like 4 months late, and I owed like an additional like $400 on a tax bill of like $1,500. Yeah. So that's not a fun day. And obviously, when you call them and say, "Hey, I made an error. Would you help me out?" They're like, "No, no, thanks. Click buy." So nothing you can do unless they do away with property taxes, which I guess they're working on. I know Travis at Real Estate Mindset's working on that with Mitch Vexler. If they do away with property taxes, I guess that won't be an issue. As an investor, I'm all for no property taxes. Cha-ching, cha-ching, cha-ching for me and other investors, by the way. But man, tax sales are something that's definitely increasing. So watch out for those in your market. It could be a good way to pick up a deal maybe. So not only do we have mortgage delinquency, we also have mortgage fraud to deal with. And I would expect as we go along, we're going to uncover more and more mortgage fraud from all the monkey business that happened over the last 4 or 5 years. And you can check out a video I made about mortgage fraud right here.